So I think what the Fed did brilliantly was to retain optionality. So we have a lot of data coming up next week. We're also going to get another payroll report before their next Jan meeting. So they created the optionality that if the data is weak, particularly on the labor front, that they can absolutely cut more. But they did sort of signal that the bar to cut any further is higher. So, and I think, you referenced President Goolsbee. I think there's a division at the Fed because the risks to the labor market and the risk to inflation are both high. And different Fed officials are putting more emphasis on one risk versus another. I think President Goolsbee is probably in the inflation camp, sort of worried that inflation has not seen much progress this year. On our end, we think that inflation, if you look at the details of inflation, service inflation is heading lower, wage inflation is heading lower. So in our base case, we do see a couple more cuts, by the time the Fed actually reaches neutral, but there's no urgency. So they can cut this, over the next 6 months. Of course, if the labor market is weak and that unemployment rate, and that's what we're watching, if that continues to move higher, I think this Fed is going to be a lot more aggressive.
Yeah, and Powell even signaled that, right? That the labor market, he was saying, in not so many words, is probably weaker than we think it is. Also, we're dealing with backward-looking data at the moment, so we're still waiting again for that more data to come in. But Priya, we know that credit spreads are tight, but you say they're justified.
Yes, if I look at fundamentals of company balance sheets, companies have not really levered up. That would make me a little nervous if the debt levels kept increasing. There are large debt issues done by companies that didn't have much debt. So we're not that concerned about the fundamentals of whether it's earnings or leverage or even interest coverage ratio. But spreads, so I think spreads are at the tighter end of the range,
Right.
but for good reason. We are a little cautious that there's going to be a lot of supply in January. There typically is. And this time, if the rest of the corporate sector, beyond just the AI CapEx companies, are deciding they need to raise money either for investment in AI, in how they're going to incorporate in their business, or M&A related financing, we think there could be a lot of supply, and that is an opportunity. I wouldn't be worried, but we are keeping some cash on the sidelines, waiting to buy when that supply comes in.
Interesting. So does the bond market broadly defined, are they concerned about some of this AI spending and the debt associated with the AI spending? Because I look at some of these issuers, I'd buy their bonds. I mean, these are great companies, great cash flows, clean balance sheets. I mean, I'd be, as much as you got, I'll take it.
Yeah, I think, when you come in with a very large deal, it has to be priced. So there was some, I would say, supply indigestion.
Okay.
When you got a lot of that supply in September. Look at all the post-deal pricing, what has happened to the market. All those spreads are tighter. So, I mean, Oracle has had their CDS widening. I think there's concerns around how much more debt they're going to need to issue. But broadly, I don't think the credit market is nervous. There's a valuation question, and do I want a little bit of a new issue concession to take down a large part? I think there's some of that. Look at the spread curve. That has not really steepened. I think there's a lot of demand for long-end corporate paper. It's the all-in level of yields. Those spreads are narrow, but look at all-in yields. If you're getting 6%, 5-6% high-quality investment-grade debt, I think that's why we're seeing continued demand, and I don't think the supply will be an issue. Beyond just that week, maybe there's a little bit of spread widening.
Priya, what's your thinking with these companies, all these big buyouts, and so many companies taking on debt? Because we know that Netflix's deal to buy Warner Brothers Discovery includes $59 billion in bridge loans. Are you concerned at all that companies are getting these deals done by taking on such massive debt?
I think that's always a concern, like LBO activity, or if there's worsening of the credit. I think, obviously there'll be some cases where maybe it's overdone. On average, so far, we haven't seen too much of debt-fueled sort of bubbles. Do we get there next year if the credit markets are open and the Fed's easing? I would still say all-in yields are not that low for companies. You're not getting free money. And so we are not that concerned. But at certain pockets, remember the cockroach hunting a few weeks ago or months ago?
Yeah.
We were all worried. I think you really want to minimize cockroaches, do a lot of credit work to know that if a company is taking on debt, will they see the productivity gains? Can they see the economies of scale? And M&A, that's going to be a big issue. We're going to be analyzing two companies merging. Do we think that they can keep margins? They can make those debt payments? So far, we haven't seen things that would worry us, but we have to stay vigilant.
So I think a lot of folks, they are fairly constructive on 2026, and it all starts with, I think the economy's in pretty good shape. I think we're going to see some decent growth out of the economy. Is that kind of where you guys are over at JPMorgan Asset Management?
We are. We think we're in a soft landing. We've been in one for the last 2 years. A lot of that is based on bottom-up company fundamentals as well as consumer fundamentals. On average, balance sheets of the corporate sector and the consumer look very strong. And I think that's why the economy's been resilient. We've had so many shocks this year, right? From tariffs, immigration, geopolitical, and yet the economy sort of powered through. In our base case, that remains the case over the next year. I am a little concerned about the labor market front.
Okay.
I'm not hearing companies saying that they're going to increase hiring. So maybe this is a jobless recovery. We have to see how long does that continue to power the consumer. Layoffs is what I'm watching. I think that would unravel some of this. But I think the Fed then aggressively starts cutting rates.